For more on where the markets are heading, we're joined by Thomas Hayes, founder and chairman, managing member of Great Hill Capital. Good to see you again. You've been right about a lot of things, but one area that I think none of us have been right about is this inflation fight. It still remains stubbornly too high for most people, I would say. Some are arguing, why not just change the range to 2 or 3%, and that would give the Fed perhaps more leeway or flexibility. And then you saw the jobs numbers or the job openings earlier today that had dipped a little bit. And I'm wondering if we're trying too hard to find good news for the Fed when the reality is that the economy is strong, but somehow we want bad news.
Yeah, bad news is good news. That's the type of environment we're in, Phil. And we got some bad news this morning that the JOLTS report came in lower than expected. The ISM manufacturing PMI yesterday came in lower than expected. So it's giving the Fed cover to pause. And what we know from history is that 12 months out after a pause, on average, you're up 18.1%. So I think there's some positive things setting up for the economy moving forward. Earnings expectations are extremely low going into this earnings season for Q1, negative 6.3%. But you're not seeing a lot of pre-announcements, Phil. So it makes me think that low bar can be easily stepped over. And I think the last key point here to open up is, this chair, Powell, really looks to Volcker's playbook from 1980 to 1982. And the one part of Volcker's playbook that he hasn't yet followed is Volcker stopped hiking rates when inflation was still at 6%. And as we look forward in the next couple of months, as we start to see those year-on-year leases roll over, as we've talked about in previous sessions, I think you're going to see inflation drop, and it's going to give the Fed more than enough cover to pause here, just below 6%.
First of all, with all due respect, I don't think it's a good idea we bring in Volcker to this conversation, because that just makes me more nervous. I actually spent the weekend and I rewatched one of my favorite movies, The Big Short. And I got to thinking, 3 weeks ago we had this earthquake, if you will, Silicon Valley Bank, and then we just talked about Credit Suisse. I mean, there's some big things happening in the financial markets that the past week I feel like we've all just kind of brushed off and said, okay, it's fixed. Credit Suisse is fixed. Everything's one off. Is it really?
It's not going to be fixed until the government steps in and backstops the deposits, either a temporary backstop for 12 to 24 months until they get through Congress an increase in the insurance limits, the FDIC limits moving forward. Until then, you're going to continue to see this steady trickle of deposits out into money markets, into the bigger systemically important banks, the big 4 or 5 banks. And that's not a good thing for regional banks. And all you need to do every morning when you wake up, Phil, the key to the market is look at First Republic Bank, Pacific West Bancorp, a couple of the other regionals. If they're red, it's going to be a red day for the market because the market knows the banking crisis isn't solved. If they're up, maybe there was some good news, a good headline overnight that makes people feel more confident. But this morning we got Hurricane Jamie back on the stage saying that this wasn't over, there were going to be repercussions, et cetera, et cetera. And I think the key here is one thing to say that, it's another thing to offer a solution. And everyone knows in markets, on the street, that the only thing that's going to put a clear end to this is not going to be the takeovers over the weekends. It's not going to be giving people back their deposits that went to your systemically important bank. It's going to be doing a backstop insurance so the deposit flight stops. These regional banks can't raise equity capital if they don't know what their deposit is going to be in 4 weeks.
But fair enough, that might be the case for Silicon Valley Bank and some of the other regional banks here in the U.S., but that doesn't explain what happened to Credit Suisse, right? They had money, their business, they were in a restructuring program. There were comments made, I guess, in the days after that led to people being concerned that they would not get backstop. And then we had this weird run on the bank, and now seemingly UBS is getting a steal of a lifetime. Their main competitor essentially buying them for almost nothing. I mean, you have to think, does that mean there needs to be more consolidation in the banking industry? And then we heard about Deutsche Bank over in Europe too. And I think a lot of us here on the other side of the Atlantic or the pond, we don't really truly understand how the banking system works over in Europe. It's not the same as here.
Well, Credit Suisse was the most telegraphed 15-year slow-motion train wreck that you've ever seen in history. Anyone that was surprised by Credit Suisse's demise has been sleeping under a rock. every single bad trade, every single crisis, every single controversy on Wall Street for the past decade, Credit Suisse has been front and center. It was a cultural problem. It was a leadership problem. UBS certainly got a steal, maybe for as low as 5 cents on the dollar with an unlimited government backstop. It's going to be highly accretive to UBS, and they're going to come out of this pro forma with $1.5 trillion of assets, a tremendous business, but they're going to have to cut at least 30% of the staff, if not more, to make sure that culture doesn't creep over to UBS.
So back to the rates and what Chairman Powell is saying. We are now, I think the last number I saw was there's still a significant portion of people who think there's going to be another 25 basis point rate increase. A number of other experts are calling for no hike at all. And I'll go back to what I said earlier. I feel like we are just now feeling the first impacts of the earlier rate hikes from roughly 12 months ago. What should the Fed do and what will they do?
What they should do is they should have stopped 50 basis points ago. What they will do is probably raise another 25 basis points because they haven't gotten the message from the banking system yet. But the market's already gaming this out. You're seeing the dollar weaken. You're seeing Treasury yields compress. And what that's telling us is the more they raise now, the more they're going to have to print later. As you look, gold is now approaching a 5,000-year high.
Did you say 5,000-year high?
Yeah, if you look at the long-term charts, we like to look at long-term data. So the market's already sniffing this out. They can tighten and try to be Paul Volcker, but at the end of the day, it's going to cost them more in terms of the bailouts and in the case of breaking things like they've already started to see with the regional banks, with Credit Suisse, with other things. All these banks have unrealized losses. All these banks need to raise equity capital. And if you keep jamming up rates, number one, these people are going to have to pay more money to keep the deposits in the bank. And number two, they're going to take more unrealized losses on their portfolios and have to borrow from the discount window. It's bad policy. They just have to accept above trend inflation until those leases roll over.
Fantastic stuff. Always good to see you, my friend. Appreciate it.